Welcome to this week's market drama. The S&P 500 was up 2.5% last week. Year to date is now up 17.6%. NASDAQ was up even more, 3.2% for the week. Year to date is up 34%. Treasury bond yields fell, which means bond prices went up. And this is all in the back of softer than expected job data. So let's take a look at some of the data points there. In August, U.S. non-farm payroll was mixed. Total non-farm jobs numbers of 187,000 were above expectations of 170, but we did have negative revisions to prior months. Labor force participation was up to 62.8%, which is the highest level post-pandemic era. It means essentially more people are either working or looking for a job. And why is that something that the Treasury market will care about? Well, the more people that are out there either working or looking for a job, the less pressure there is in wages, right? And wage growth is directly linked to inflation. So average hourly earnings was up 4.3% year over year, which was in line with expectations. And it was below the 4.4% we saw in July, right? So that trend continues to come down. The Federal Reserve has mentioned in the past that if they see this average hourly earnings below 4%, it starts to align with inflation number somewhere around 2 to 3%, which is what they're shooting for. So that number keeps coming closer and closer to 4%, which is a good sign for inflation expectations. Lower inflation expectations means the market is looking at the Fed and saying, okay, this probably means you're close to stop hiking interest rates and maybe even lowering interest rates next year. That is good for stocks, and that's why the market's acting the way that it is. So if we continue to see better than expected inflation numbers, loser job market, but not a full-blown recession, that seems to be the sweet spot for Treasury yields to be falling and for stock markets to continue to go up. And that's essentially what we saw this last week. That's it for this week. Stay tuned for next week.